G'day expats, welcome to another episode of Expat Chat, episode 42. And as always, joined with my co-host, Brett Evans. How you going, Brett?
Well, thanks, mate. Well, thanks. And for the folks out there who want to know who I'm talking to, that'd be my mate and colleague, James Ridley. He's the Managing Director for APAC. How's Australia treating you, mate?
Mate, it's good. It's actually starting to get a bit cooler. And I mean, with you taking care of the EMEA region, it's hard to get that off the tongue, to be honest. But obviously, Brett, you're Managing Director of the EMEA area.
Say that after a few beers.
I know. Well, that's the thing. Talking like it, to be honest. But,
That's right.
how's the sandpit going? I know you guys have got a public holiday coming up soon, don't you?
Mate, we've got Eid coming up, which is virtually the Australian equivalent of Bush Week, when everyone just goes, gets out of here. So we're obviously going through Ramadan right now. So those who follow the Islamic faith are fasting, and it's a celebration of eating lots of food and catching up with family. So we're not sure yet the exact dates. We've got a rough idea coming up, but certainly looking forward to it because we see everyone else enjoying Easter long weekends and Anzac Day long weekends and everything we don't get. And we're looking forward to a couple of days off, that's for sure.
I know it's, the long weekends that we had and we just had, and we're about to have another one. They're a two-edged sword when you're busy because you come back and you got to really dig into your emails and it's everyone's just been head down, bums up, to be honest. It's been good. It means, obviously everyone's working away grinding because obviously they know they've got another 4-day work week coming up. So really got to get things done. But I mean, today I wanted to have a chat to you about some good, I suppose, end of financial year tips because right now it's the 21st of April. We've got 2 months almost left on the dial, and always factor and find that a lot of clients, they sort of come back towards the end of the year, or especially, I suppose, even just general inquiries. They want to know things that they can do towards the end of the financial year to improve their situation, whether it's retirement or things that they should know, some tips. So I wanted to jump into that. But first, I think we get that general disclaimer from you. Let's see how you do today.
Yeah. First of all, I want to do a massive shout out on the YouTube channel to Purple Donut, who said they love my quirky disclaimers. So I'm going to flip and flop between these things, but all the information that you're about to hear today and experience and enjoy should be treated with the same amount of certainty and degree that Mr. Albanese has when quoting the cash rate and the unemployment rate, e.g. don't take any notice of it. All information should be used for entertainment purposes only, and please speak to your financial professional to get personal advice.
That was pretty good. You practiced that quite well.
That was on the fly. I swear to God, that was on the fly. Mine's going to 1 million miles an hour. So
I can attest that. I could see that his eyes were not moving across the screen back and forth. That's quite good. Now, jumping into it, end of financial year, fast approaching. We're probably going to start seeing the EFS sales come up as well, as they always do, EFS. But I suppose what I want to discuss is just some really common easy tips for expats that they can focus on as we wind out the end of the financial year. Just before I had this, we're recording this episode, I was having a really good long consult with some clients coming on board and trying to action some things before the end of the financial year. Some of it's tied to super, some of it's tied to property, insurance, consolidating, all those sort of things. So I wanted to go into that today.
Yeah, and look, I think it's a good time of year to bring it up because what we often find is when it comes to expats managing their money, it's like handing in university assignments. If it's due at 5 p.m. on a Friday afternoon, they'll hand it in at 4:59 p.m. There's always that scramble in late June, whereas you can be quite sedate and structured and organised and do this stuff now and then not have to worry, in the last week of June about transfers and all those sort of things. So certainly I think it's a great idea to run through this conversation and really just sort of cover off some of those key points that people need to address because sometimes it takes a little bit of time to work it out. But get it out of the way now, tick and flick, and make your life a bit easier as you approach 30 June.
Yeah, that's right. I mean, I'm going to start with, I guess it's not one that expats commonly think of, but it's something that we can't really escape anymore. They changed the rules back in 2018 and it's HECS debt repayments. Now, when we talk about HECS and the degree and rate it goes up, it's indexation. Now, early June is when HECS or indexation gets placed onto your HECS debt. So if you wanted to make an early repayment, that's actually probably in your best interest before June. And the reason why is because you won't have that indexation factor placed on that amount that you're putting down on your HECS debt early, whether it's 1%, 3.5%. Indexation with HECS debt, it doesn't go up drastically each year. As we know, it's been pretty low. It's been 0.6 to sort of 1.5%. But just remember that we've just come off the back of a year where I suppose CPI has been quite high. So this year will probably be the first year that we see indexation on HECS debts actually be a little bit higher than normal, which makes sense. So if you were going to jump in an opportunity, then, putting down a little bit on your HECS debt before June would make sense. Save yourself a couple of dollars.
Yeah, and look, just got to do a massive shout out to Mitch Kelsey, who works out of our Australian office and looks after clients in the Asia and US region. He wrote a cracking article on this about how to save, I think, work out $500 for nothing. By using this strategy. So I'll put his article in the show notes because it's a brilliant. I've been doing this and you've been doing this for a long while, and I thought, yeah, that's clever actually. I like that. So, and that's what we want to bring to folks out there is really, just understand, these little tips and tricks that people can take advantage of.
Yeah, that's right. And I mean, moving on to the next one, superannuation. So, I mean, HECS, again, can't escape it, but there's an opportunity there. Read the article, see what you think. Give us some feedback on that one. Superannuation, it's pretty common. Expats, they leave it in the wind when they leave Australia, and then they usually come back and try and fine-tune things and pick things up 10 years out before retirement. So it's a good opportunity leading into the end of the financial year to attend to it. Now, what are some common things that we can think about, Brett, around super as we approach the end of the financial year?
I think something we see on a daily basis is a lot of confusion about contribution categorizations to super. Yes. So essentially there's two ways to contribute to super. There's what we call the concessional or pre-tax contribution and a non-concessional post-tax contribution. Met with a gentleman last week. He was making concessional contributions. He quoted the 27,500 cap. He was paying 15% contributions tax for no reason. So I think it's important we take a step back and really just sort of look at that. So when folks were living in Australia, their employer was paying 9.5, 10% of their salary to super. That was
10.5%.
I know, it keeps going up. Yeah, I know. I'm finding it difficult to keep track of. So what that means is if you're earning 100 grand a year, $10,000 will be paid to super as a concessional contribution. That's the 10% at the moment, soon to be 10.5. And as that money goes into super, it'll be taxed at 15%. But then that reduces your assessable income by $10,000. So now when they apply the marginal tax rate, it's only on the 90,000. So that's what's called a concessional contribution. Now, most folks who live overseas don't do concessional contributions because A, their employer is not contributing, or B, they don't understand how to make that work, and we'll run through that in a sec. The second option is the non-concessional contribution, which is out of post-tax dollars, AEG, out of your bank account, and you can contribute it up to $110,000 a year. So whether you use one or either or both will depend on your circumstances. Now, do you want to run through, James, one of the reasons why someone would elect to use a concessional contribution strategy?
Yeah, I think probably the most common one would probably be when they're trying to offset some sort of income, and that's income that's Australian source. So probably the most common would be rental property income. After all our relevant tax deductions on that rental property, from a tax perspective, we've still got some positively geared income. So we might have a property. We're actually got gross rent of maybe say 25,000 per annum, but then we've got all the tax deductions, interest expense, which add up to being maybe say 15,000. So we've got a good amount there, the difference, that we then place and can place into super as a concessional contribution if we want to, if it makes sense. And then we can claim that as a tax deduction.
So just explain to the folks how that would be taxed. So that amount, once they've taken up the deductions, how, if they just receive that income as positive cash flow, how would that be taxed and what rate?
Yeah, well, I mean, if they didn't do anything with super, it would be taxed at 32.5%. So a third of the income essentially goes to the ATO. Very expensive. And unfortunately, it's just the way that our non-resident, or I should say slash foreign resident tax rates apply to Aussie expats. We don't get a tax-free threshold of 18,200, was meant to be 20,000, it's not. We don't have that tax tier of 19% tax rate tier. So it's straight up to 32.5%, no tax-free threshold. And it just means that, yeah, you're paying a fair bit in tax, the ATO. The alternative method is, yeah, you can put that net rental income into super. That's no issues at all. You can claim that as a tax deduction and commonly referred to as a Division 290 notice. And then by doing so, you get given a receipt by the super fund. It's a 1 to 2 page document. You then provide that to your accountant. And that means that you can claim that as a tax deduction. The benefit there is that when you look at the difference in tax, well, when it goes into super, it's actually only taxed at 15%. So you've actually effectively saved yourself 17.5% tax out of pocket automatically. You've had one asset paying into the retirement asset, funding a retirement vehicle for the future. And again, it's been very tax efficient. You saved yourself a fair bit in the process as well. So
and two birds with one stone.
That's right.
You've also topped up your super.
Yep, exactly right. So that's probably one of the most common strategies around that. And then I guess there are a few other options that we have. I mean, Brett, did you want to talk about the, expats returning home, non-concessional contribution opportunities?
Yeah, so to me, this is one of the ones that I'm talking to a lot of folks right now. They've been overseas for 10, 15, 20 years. They build up some sort of foreign pension, in the service benefit provident fund. The biggest problem that we face is due to the contribution caps as a non-concessional, which is $110,000 a year, people find it difficult just dumping a lump sum into super. Now, there's a couple of really beneficial rules around non-concessional post-tax contributions in the super that you take advantage of. And one of them is what we call the bring forward rule, which says that we can actually make 3 years worth of contributions in 1 year. So instead of only being limited to 110,000, we can actually put in 330,000 into super. What that means is if you do that, you can't do anything for the next 2 years. But if you're clever and you can straddle the financial years, you can actually make a little bit more. So as an example, you contribute 110,000 in this financial year, the 2021-22 financial year, up to 30 June. So say you do it on the 27th of June. And then 1 July, you're in the new tax year, then you can contribute 330,000 using the following tax year and the next 2 after that. So what that virtually means is you've just got $440,000 into super. And if it's a couple, 880,000 in super. So that to me is a really good strategy. The good thing is they're lifting the age in terms of how old people have to be when it comes to making being limited to using the bring forward rule. So in the past, it was up to age 65. If you're over the age 65, you can only put in per annum amounts of $110,000. Now they've lifted it to 67 and it's going to go soon on the 1st of July up again to 74. So what it means is it's going to make life a lot easier when it comes to repatriating pensions, savings, super accounts and those sort of things for expats returning to Australia. And we going through 2 scenarios this right now for clients. Even if you are not intending to retire to Australia immediately or repatriate to Australia immediately, it's still a good strategy. And the reason being is, let's say, for example, you're in Dubai, Hong Kong, Singapore, and you decide to retire somewhere in the region. You might be doing a bit of travel. You might be using the retirement visa in Thailand or Portugal. There's a lot of other things around that people take advantage of. You can still build your super balance using these non-concessional and bring forward contributions and draw upon and then you flip it over once you pass preservation age, you flip it over into an allocated pension in Australia and that funds your retirement overseas. So now you've got the best of both worlds. You've got your money sitting in a jurisdiction which is safe. You're getting an income tax-free from the ATO. They can't touch it. It's tax-free. It's an allocated pension. Receiving the income overseas into a jurisdiction which either is low or no tax, suddenly you're funding a tax-free lifestyle which with full control, full transparency and full liquidity. Now, what we find with a lot of folks is they might retire at 60 and they might spend the next 10 years or 15 years overseas, but then they want to return to Australia at some point.
Yeah.
And because they want to take advantage of the good healthcare system and be close to family in their sort of later years. Then the great thing is they don't have to change it. Their retirement account is sitting there. It's been funding their retirement while they're running around the world, having a great time in their early retirement age. But in their later retirement age, it's still sitting there, it's still funding it, and still tax-free.
Yeah. And I think a really common theme that we always see with expats is that it's usually on the back end of approaching retirement, 5-10 years out. Superannuation hasn't been contributed in maybe 25 plus years, and it's small. It's not set up correctly for retirement. All the other assets are in some foreign currency, which leaves a huge exposure to currency risk there, especially if you're coming back to Australia, having everything foreign currency, foreign retirement vehicles, those sort of things. So there should be a focus on building still the Australian retirement vehicle if you have an intention of coming back and retiring in obviously beautiful Australia. So it's something which, expats, they don't focus on too much, and it makes sense that they wouldn't because obviously they're overseas, but it should be a consideration when they're considering the overall long-term sort of runway when it comes to retirement planning. Absolutely. And I guess expats, very common that we all have, or we've all had multiple super funds. So I guess at the end of the financial year, it's always a good time to reflect on whether you need a consolidation in terms of if you've got multiple super funds, if you're lucky enough to still have your MyGov login and the ATO services link, you've been wise enough to switch off the two-factor authentication before you went overseas. It might be, a good idea to consider consolidating. Insurances is always another thing within super.
Yeah, insurance, and that's the thing. A lot of people think if I've got insurance through one super fund, it's the same as the insurance through the other super fund. When the super funds negotiate those policies with the insurer and the reinsurer, quite often they'll trade off some features in order to achieve lower premiums. And one way they might do that is they may actually exclude expats. So even though you're paying your annual fees, your annual premiums, you cannot claim on that while overseas. So virtually you're paying something for nothing. And we've had success in the past in terms of helping clients claim that back because the super fund knew they're overseas and they're still charging. So there's a bit of smoke and mirrors there and they don't want to admit that. But long story short, it's can be quite significant. I've seen cases of $2,000, $3,000, $4,000, $5,000 a year, sometimes even higher in premiums that people are paying for virtually nothing.
Yeah, I know. Recently had a consult with a client. Their annual insurance premiums are about 8,500. They're about to go up to 9,000. So we're just looking into the validity right now, speaking to the underwriters in the background and those sort of things, because that's a lot that's coming out of super, and if it's providing no benefit. And remember, super fund doesn't really have the super fund doesn't have the requirement to tell you it's invalid. You're the one as the member that needs to do the research to find out whether it is valid. And there's, I would say 6 out of 10 super funds, maybe even 7, very common. It's not valid. There's sort of exceptions where they might say, oh yeah, if you come back to Australia to be assessed, might pay out the claim. You're not really hopping on a flight if you're permanently disabled or to lodge an income protection claim to come back and be assessed. Let's be honest. So it's a cheeky little way that they sort of get out of maybe paying it. A lot of the time when you talk to a lot of the client consultants as well, just remember they're mainly trained to regurgitate what's in the product disclosure statement. It's a case where you need to do the research. You need to get behind the closed doors, speak to the underwriters to see what the result would be if something happened and you needed to make a claim.
I think you're spot on there. And we've seen cases before where clients have taken the initiative, called up and said, hey, I'm going overseas. Is my insurance still valid? That person answering your call is not a financial professional. They're a call center operator. As you say, they've got a database of responses and they may interpret you going overseas on holidays or a work trip. They go, yeah, of course you're covered. It's important to explain the difference of the subtleties of going overseas and living overseas permanently. Because when you do that, then they go, wait a minute. And then 9 times out of 10, you'll get transferred to a manager and then, transferred to the insurer and that sort of stuff. A good, a good tip is to try and communicate with your super fund via email. Because then you got a written document. If shit goes sideways, pardon the French, if shit goes sideways, then you've got that document and say, hey, no, you said to me that I live having overseas and I'm still covered. Because otherwise you have to go back and look at tapes, which they record the conversations. You spoke to Shelley at 11:18 a.m. on the 27th of whatever. It's more of a convoluted response. Whereas if you've got an email chain that says, hey, this is the case, then you can furnish that report pretty quickly.
Yeah, absolutely. And I think, one last thing I was going to add would be a really common theme, and I've mentioned it before, is that probably in the last 12 months, had a lot of clients and a lot of inquiries around selling main residences or investment properties because of the property market. And a lot of those are using what's called a catch-up concessional contribution.
Yes.
That is a little bit more advanced, that one, because there are some conditions around previous contributions from the 2019 financial year, but it's essentially...
And also balances as well too. Your balance has to be below 500,000. So it is good if you've certainly haven't contributed to super in the past and or your balance is quite low, but just be careful of that one. It is one of my favorite tools in the tool chest that I use at the moment.
Yeah, and it prevents tax leakage. It's a good form of wealth transference into retirement. But there's a few ins and outs with that one. I don't want to go into that one too much because if you get it wrong, you could be up for a huge tax bill as well.
Yeah, if you get over contributions combined with, anyway, it gets expensive if you do it the wrong way. So, mate, I think we'll leave it there for today. One last thing, I did want to mention to folks is if you do have rental properties, if you haven't done it before, getting a depreciation certificate, is a nice little one. There's still many people who don't have those. And if it is applicable to you, definitely do it, because if your property is running positive cash flow, that can make the difference between positive and negative cash flow from a tax deduction point of view. So that's my last one. But mate, we'll leave it there for the folks, and we'll see you on the next episode.
Sounds good, mate. Thanks for stopping by. Speak soon.
Thanks, mate. Take care.